have a little bit more of a conversation about investment planning. And then really this is what we're going to be working on. You're going to be responsible for, you know, a smaller one of these for the exam. So the key takeaways from this chapter, chapter 11, are sort of, well, I mean, twofold. I want you to be able to track your investments, which is that's what this does, and we're going to learn about that. And I want you to be able to calculate a return on your investments. What did I yield on an annual basis so that you can compare them? And then obviously I want you to just know, you know, the basics that we covered, primary versus secondary markets, and what's NASDAQ and what's the Dow Jones, and et cetera, et cetera. So just to go back and pick up where we left off, I believe that the last couple things that we did, and correct me if I'm wrong, wasn't the last thing that we did was calculate return?
Yeah.
Okay. So this is a really important formula, right? How do I calculate how well something I bought? I investigated a bunch of stocks. I decided to buy Walt Disney. Okay, great. How do I just determine what I'm yielding? So the numerator is how much this has appreciated, right? Ending value minus beginning value, plus your annual or your income cumulatively divided by what you paid for it. And that's going to give you your cumulative return. If you want to get that to an annual return, you have to divide by what?
$365.
No, good guess, but not correct.
The number of years?
The number of years that you've held on to the investment. So if I've earned, you know, 226%, it's like, wow, well, yeah, but you've held the stock for 40 years. So that's really 5% a year. So we practiced. The Walt Disney example was a little deceiving because it was only for 1 year. So when I got to my 11.91%, I divided by the years, which was 1. So I still ended up with 11.91. But if that had taken me 3 years, I would have had to divide by 3 to get the annual rate. So I just wanted to keep going. So how do you make transactions in the securities market? And I think we learned about primary markets is where the big IPOs are, right? The initial public offerings. But like, how do you, you know, it's just you or me personally make trades in the market? So, and you have lots of different options. You can have like a full service broker. So I call up Edward Jones. I'm like, oh, okay, I just inherited $250,000. I need a broker. I want to hire him or her. I interview him, I hire him, and now they manage my money, right? So the thing is twofold. I learned this lesson at a pretty young age that was a little shocking. Brokers don't necessarily have your best interest at heart. I mean, you want them to, and you think they do, but what they're really interested in is their commission structure. So I do taxes for about 50, 60 people. And I always, when somebody comes to me that's new and they say, oh, I'm using, you know, Merrill Lynch or Edward Jones or whatever, and they give me their brokerage statement, the first thing I want to watch for is churning. Any idea what that means or what I'm looking for? It's a broker that's buying and selling and buying and selling and buying and selling out of your account. Why is that not a good thing for me, maybe?
Because if you don't keep the same stock or the stocks for a long period of time, you're losing money. Because the point of buying a stock is for it to grow over time, and that it takes 5 years at least.
Well, that's a random number, but yeah, it could. And something like Tesla, you buy it at 500 and 2 weeks later it's at 900. It might be a good thing to sell. Sometimes things really spike in the short term. So what you're saying is generally true, Shasta, but not always. But a broker makes his or her money how?
They make a commission, but I thought that was off of just how much you allowed them to invest. Do they charge you every time they buy and sell the stock, the
Well,
fee?
that's a great question, Gabe. It depends. There's different kinds of accounts. If you're pretty high net worth, say I brought $1 million to the table, they might look at that and say, you know what, I'm just going to charge you an annual fee based on your net worth. Or they might have, and there's lots of different models, or they might say, you know, I'm glad you're starting to invest, Lisa, you've got $10,000, but what I'm going to do is I'm going to charge you a commission every time I sell something, right? So if they're churning, selling, and buying, and selling, and buying, and selling, and buying, they're making money every time they're turning that over. And I'm not even necessarily saying that's a bad thing. It may be appropriate in certain scenarios, but you just need to make sure that your investment objectives are aligned. And this is like so critical. If you go to, and you're hiring a broker and they ask you a bunch of questions, like, what do you want to accomplish? So Michaela, you're in your what, mid-20s roughly?
I am 20.
Oh, you're early 20. Wow. Okay. So gosh, you've got a whole ton of years in front of you. So if you came to me today and you're like, I'm getting ready to graduate, I'm getting my first job, I want to start putting $100 a month in my 401k, and I was your investment broker, my first question to you should be, hey, Michaela, what are your goals? What are your financial goals? So, and I think we've gone around at one point in time and kind of done this. So some of you said, you know, I get my student loans paid off, or, you know, a lot of you aren't really talking about retirement yet, but it doesn't matter. You need to feel like I'm on the same page with your values, right? And I know that this probably doesn't mean a whole bunch to some of you right now, but the kinds of things I'm going to put you into, that I'm going to invest you in, should be aligned with your values. So for example, Michaela says, like, I'm really risk averse. I'm not going to put her into the OTC market, the over-the-counter market, because that's really high risk. There's an opportunity for a huge return, but there's also an opportunity to lose everything, right? So you really need to make sure that your value aligned. Then there's discount brokers, like a Charles Schwab, where you get limited access to an actual human being. I don't know what the Bank of America model is. I'm assuming it's the same as Schwab because it's on the same line. Or what, and I would probably venture to guess that folks in your generation are really going to be targeted here, where you just go on and you're like, I'm going to sign up for my own account and I'm going to put $100 a month away into it, and I'm going to buy and sell my own stuff and do my own research. You know, those are all different levels of somebody that you're going to have access to help you with your decisions. Does anybody have any questions about these three kind of different models of brokers? And everybody makes their money somewhere. That's your first question. Like with Schwab, for example, I think it's like a 4.07% commission or something like that. So when you make a trade, you've got to yield 4% just to break even. If I pay somebody 4% to buy that stock, I have to earn 4% just to break even. So you need to make your choices, as Shasta alluded to earlier, for the long term.
Is like a full service broker, do you have a person you could talk to, like and is this like brick and mortar type?
That's an excellent question. You would think that you would, right? Hi, you know, Carson, thank you for agreeing to be my broker. I'm going to bring my little, what I think is a huge account, but in the whole scope of everything is a little piddly ass account, $50,000 to the table, and I want you to help me invest it. And Carson's like, oh God, it's my turn to take the low income person on, or the low net worth person on. I want to think, because it's all the money I've saved in my whole life, I want to think that Carson is like got my best interests in at the top of his mind. But you know what? He's got 50 clients that are worth $1 million plus. I am so far down on Carson's list of priorities that, yes, Philip, I would like to think when I call him and say, hey, what do you think about this? Or I'd like to adjust my portfolio like that. I'm going to be lucky to get Carson to call me back. Now, if he's fresh out of college and I'm one of his first 5 clients, Carson is front and center for me. He's like picking up every time I call because he wants me to tell my 10 best friends that he's game on. So that's another question when you're looking for a broker, and you can be really honest about that. I had no idea the questions to ask when I was in my 30s and was first trying to do this. But one of the questions is like, what's the average portfolio that you manage? And if he says $890,000 and you've got, $1.50, you're not going to get his attention. Trades can be traded. You can do it by phone. You can do it, online, Anybody know what a day trader is? Ever heard that term?
Yeah.
What is it, Gabe?
So you're doing a bunch of micro trades. Now it's all through computers because they're better than people. So you have a program that, say you buy like a bunch or $5 in this one stock, and you have it set up so if it goes down and you lose 2 cents, it instantly sells. But if it goes up 1 cent, or you have like parameters that you set, and it's just it's pretty high risk because you're doing a bunch of tiny trades. It's actually mostly what Wall Street is now, is all just tons of supercomputers just constantly doing millions of trades a second.
That's a very good description, and maybe a little past our scope, but 50 years ago, just to give you an example, and you may or may not be interested in this, but my dad owned a construction company. He'd never been to college. He wasn't an educated guy. He just went to work when he was 16 and built his construction company, but he loved numbers and he loved the market. And so he had this pad of paper, and every day he would go on. And do you remember what a ticker symbol is? I told you guys like what the symbol was like on the market. VRZN is Verizon, and ROKU is Roku. And okay, so he'd take the ticker symbols and then he'd write what the stocks were at every day, right? So it's huge ledger pads of paper full of little numbers. And 50 years ago, my dad was playing that game because he was good with numbers and he had a feel for the market. He could actually sometimes outperform the market in a year or in a quarter. What Gabe's saying now, where we've got basically supercomputers that are micro programmed to trade on little tiny shifts in price, the odds of you or I ever outperforming anything would be complete and sheer luck. So day traders do it because they enjoy the high. I've got a good friend that's a day trader. But again, here's the key, and tell me, somebody explain that. What does this mean? Cameron, what does that mean? The change in price has to cover the trading cost.
I don't know.
What's a trading cost? What do you have to pay when you trade? That we were just talking about.
I wasn't here.
Oh, it's a commission.
My bad.
Most often you have to pay a commission when you make a trade. So if somebody's charging me 2.5 cents to trade the stock in these pencils, I have to make 2.5 cents just to break even on the trade, right? Before I can even get to a profit situation. So when you're trading on these micro amounts, that's an issue. Okay, so, and again, a lot of this is a little bit probably more than we all want to know, but there's different kinds of orders. These number 2 and 3 is what Gabe was talking about. You stop loss. So say that I've invested in, Google or something, and it's trading at $339. And I put in a stop loss order at 325. So if the price starts to plummet, I don't have to sit here when I'm out, at a restaurant with my friends and be like checking my phone every 10 minutes because I don't want to lose my butt. I've just put a stop loss order in. And when it hits $325 a share, all my shares are sold, right? So that's a stop loss. It can't just plummet and plummet and plummet on me if I'm not paying attention. Or conversely, a limit order is on the other side when So, back to Tesla, bought it at 494, and I mean, God, it was trading at $1,300 a couple weeks ago. Okay, man, once that hits $1,000 a share, sell it. When it's a specified price, sell it. I want to cash in. So those are different kinds of orders. This is a little, I'm sorry to keep saying beyond our scope, but margin, short selling and trading on margin are for pretty sophisticated traders and people in the market. A margin account is when you don't have enough money. Like, I think, Nicoya is going to hit it big, and I've got $8,000. Oh, that's not a good example. I've got $80,000, but my broker says, you know what, I'll borrow you 100. So I buy $180,000 in Nicoya. Only 80 of it's my money. The other 100's his. I borrowed it on margin. And if Nicoya surges and doubles, I sell it. I pay him back the 100 grand with some interest. And I've just made a bunch of money on somebody else's capital. Okay. So that sounds great, right? Why wouldn't everybody do that? Carson, why do you think that's maybe not as good of an idea as I just painted?
Hold on, can you repeat that one more time?
Sure. So there's a hot stock. I think, let's just use Tesla because that's exciting, and it's a very exciting stock to follow. So I think Tesla, they just came out with their first quarter report. They pushed a bunch more cars out the line than anybody thought. They're getting ready to sign this big trucking contract for electric semis. I think the stock's going to skyrocket, but I've only got $80,000. Phillips, my broker, I'm like, hey, can I borrow another 100 grand from you? And he goes, sure, I'll charge you 10% a year interest on it. So he gives me 100 grand. I take his 100 grand, my 80, and I put 180 into Tesla. Tesla skyrockets. I sell it. I pay Philip off. I pay him his interest. And I've just made a shit ton of money on somebody else's money. Sounds like a winner, right? What's the downside? Or the down potential to what I just painted?
Well, I mean, once you already cashed out and got your money, what would be the risk? I mean, I know if it doesn't turn out the way you think it does, and it kind of gets overhyped, and then you're kind of screwed because you owe him money too.
That's exactly what happened. So Tesla doesn't get the contract for the semis, and Tesla plummets. And I'm like, oh my God. I put in a stop loss order. My 80,000 is now worth 60, and the 100 I borrowed from Phillips now worth 81. I've got to come up with $19,000 plus the 81 to pay him back the 100 plus interest. So trading on margin, huge upside, huge downside. So it's really not for the faint of heart. And that's why I'm saying it's a little beyond our scope, because what I'm hoping all of you will take away from this is that the market isn't a really scary place to be if you're being really mindful and methodical about it. And the way to be mindful and methodical is in a couple ways. So the first off is you want a diversified portfolio. What the heck does that mean? Asher, do you know what those words mean?
Doesn't it just mean investing in a lot of different sections of the market so that your risk, so if you have everything in tech and tech just goes down the drain, then you lose everything. But if you've diversified your portfolio, you're also invested in housing and I don't know, medical. So if technology sector takes a dive, you still have funds in the bank.
Yep. So Asher just really hit the nail on the head. There's a couple things. One is you want some bonds, some stocks, and some real estate, and some cash, just, sitting in a money market getting 0.2%. But the other thing is, even within those things I just described, stocks, bonds, real estate, and money markets, you need to segment. So not just bonds, but some international bonds and some American bonds. And not just stocks, but some global stocks and some United States stocks and some European stocks, right? That's called diversification. And then you can get super micro with all this. And I mean, my eyes glaze over in 5 minutes when like somebody that's really into this world starts talking about how you can micro segment everything. And that's great. There are instruments now that do that for you. In other words, instead of me going, oh my God, this is so complex and I want to make sure I'm in all these different markets to diversify, there's funds, mutual funds that just follow different targeted demographics. So you don't really need to think about it. The people that you pay to manage the funds do all that. So I'd like you to take a look at page 461. And let me also just tell you that on the internet, I mean, there's a million different, they're called model portfolios or model portfolios. So on page 461, I'm just going to kind of read to you, forgive me. The type of portfolio that you put together will depend on your financial and family situations, as well as on your investment objectives. If you want to be wildly rich, you're going to need to take more risk. If you want to just be like super stable, it's like, okay, that's another thing. Clearly what is right for one family may be totally inappropriate for another. Take just a second, please, and look at these 4 family situations. You don't have to read all this, but just kind of glance over the portfolio compositions. And then I just want to have a little conversation about it. So top of page 461, exhibit 11.7. So first thing I'd like to ask you is, what terminology in here are you unfamiliar with?
Blue chip?
I'm sorry, go ahead. Blue chip? Yeah, so blue chip is, I'm not going to be able to describe it as well as I'm going to be able to give you examples of it and you'll get it. General Motors, Johnson & Johnson, IBM, 3M, just like the old, they're called, you know, just, they don't do anything crazy great, but they're never going away. They just keep on keeping on. It's probably a horrible definition. I'm going to look that up while you guys, any other like terminology that you want to run by me?
So does that mean it's less risk? Blue chips?
Blue chips? Oh, yeah. Okay, here's the definition. I just Googled it real quick on my phone. A blue chip stock is a huge company with an excellent reputation. These are typically large, well-established, and financially sound. They have dependable earnings. You know, so it's like at my age, I love blue chip stocks. I don't need the new sexy startup in Silicon Valley. Okay, so tell me this then, if there's nothing else that you want to query in here. Why would a single parent, it says 40 to 50 in money markets and 50 to 60 in growth and income mutual funds. Why would you say to a single parent, say a 30-year-old, to have 40 or 50% in money markets that aren't earning very much? Doesn't that sound like not a very productive idea for a young single parent? Shasta, you're shaking your head no. Why? I mean, because, and that was, so let me just contrast that with like a mature couple only wants 5 to 10% in money markets and 25 to 30 in short-term or intermediate term bonds. And so, and yet a young single parent should be 50% in money market. What's the situation there that's different from the couple?
Wouldn't the single parent want, you know, higher risk?
No, they want lower risk because they've got nobody to rely on if something happens to their job,
Okay.
right? So maybe I won't go too much in detail here, but first off, are you sold on the fact that every single one of us would have a different portfolio if we went in and answered all the questions, right? Like Carson's from an old ranching family and they all work till they're 90. So he's just like, you know, I'm just like a slow and steady saver. And like Gavin's like, hell no, I want to be retired by the time I'm 35. So I mean, just like everyone's got different goals. And so when you go into these models and you input your goals, they'll plug out for you like, here's a reasonable portfolio for you. Okay, great. So I've got my portfolio, my percentages, right? 20% intermediate bonds, 10% money market, 50% American blue chip stocks, and 10% emerging global stocks. Now what, Cameron? Is there just one choice for each of those, or what do you do next?
All right.
Is there just one choice for each?
Yeah, I would say probably just one choice for each.
There's thousands. There's thousands.
Right?
There's thousands and thousands. If right now we went and tried to find an emerging market mutual fund, and emerging markets are like Brazil, Russia, India, China, you know, yeah, those are the big four. If we went and tried to find a mutual fund for that, we would have 5,000 options. Holy shit, now what do I do? That's why you have a broker. Or you can just be somebody like lots of people I know that's like, you know what? There's thousands of these things. I'm going to look at their ratings. Morningstar rates them 0 to 5 stars. And I want one that's at least 10 years old because I want to see some history. And then just throw your hat in the ring and give it a shot. Right? Just based on the ratings. So, I mean, that's an option too. Okay, this is a super, so now we're going to take a look at how we track our investments. We're going to go on to Yahoo and see how you see what price your stocks are trading at or your mutual funds, right? Everything has a ticker symbol, mutual funds and just individual stocks. And you're going to track your investments and they'll tell you that once a year, you need to rebalance your portfolio. So what happens, you guys, is and let me just make it super simple. Say my portfolio is 70% United States of America companies, you know, stocks, individual stocks, and 30% are international bonds. The stocks, okay, first off, let's just go back to basics again. Stocks pay what and bonds pay what? Michaela, what do stocks pay me?
Well, stocks can pay dividends.
Stocks pay me dividends and bonds pay me what?
Is it interest?
Interest. Okay. Who's picked on for a while? What, Gavin, is the dividend reinvestment program? We've talked about that. So my stocks are paying me dividends. Do you want that check for $5.19 sent to you so that you can cash it and buy a cup of coffee?
No, you would want to reinvest it into other stocks, right?
Exactly. Don't send me the $5.19. Take it and buy a little bit more stock, right? Or mutual fund, whatever we're talking about. So at the end of the year, because I've gotten a lot of dividends and I've reinvested them, now my portfolio is 74% stock and 26% bonds. What do I need to do? I want to rebalance it back to the 70-30. And that's something your broker does for you. It's like, I want to stick right there on that 70-30. And after I reinvested my dividends all year, now I'm at 74-26. That's not my allocation strategy, right? So rebalance it. In other words, sell some of the stocks and buy some bonds so I'm back to that 70-30. How often do you change your allocation? Do you stick at 70-30 forever? 5 years, 10 years, 1 year? I don't know. How long do you stick with it?
Depends on the situation.
It does depend on the situation. So you're a young guy, Gabe, you're starting to invest your $50 a month. Okay, great, great, great. You get out of college, probably first major life, alteration. Okay, I'm going to re-examine what my strategy is. 5-6 years later, you find a partner. Great. Different again. Now we're 2 income. Maybe you have a kid or 2. Wow, now we got to save for college. So there's no like hard and fast rule, but when your life situations change. The biggest thing I think is when you're in those really, your quote unquote high earning years, which is 40 to 60 years old, that you are slamming as much away as you can because you're quote unquote running out of time. And then as you get closer to retirement, you start to shift those portfolio allocations again. Let's see, where are we at here? Okay, so what I'd like to do is show you how to use Yahoo, yahoo.com to find the prices and to read a stock quote page. And then I'd like us to focus on making an investment tracking sheet that looks like worksheet 11.2 on the top of page 462. Which, did I just think I said that, or did I say please have that done?
I don't recall it. I think we might not have just gotten to this part of the PowerPoint and.
Okay, I wrote it down in my notes, like, tell them to have this ready for Tuesday, but I honestly don't really remember saying it, and nobody else does it? Okay. Okay, well, that's just what it is. Okay, so let's do this. So let me tell you what we're after, and then we're going to go to yahoo.finance. So this is a couple. You have to know what date they're doing this as of. So as of April 9th, 2018, they wanted to see where they were at. Realistically, what do you guys think if you got a couple, your grandma left you a couple $1,000 and you bought a couple shares of stock, how often do you think you would want to like update your inventory or your holdings? And you might not have the same answer. I'm just asking each of you.
I would say it depends if you're a person. If you pay a lot of attention to the market, you can definitely make more money by if you keep track of businesses and you change your investments. But if you're not really on top of that, it's better to just go with kind of safe things, and then you can't just ignore it for quite a while.
So are you gonna do this inventory like once a month, once a week, once a year?
I would do it monthly.
You would do it monthly, okay? Gavin, what do you think?
I don't know. Maybe other 2 weeks. Kind of.
You do it every 2 weeks. Okay, all right. You're somebody that's on top of it. Philip, how about you?
I do it yearly, I think.
I do it twice a year. I do it on June 30th and I do it on December 31st. And I'm going to tell you why. And I do agree. Well, actually, I agree and disagree with Gabe. So his contention is that if you pay attention to the market really rigorously, like say every morning, like my buddy, he's retired and this is like one of his retirement pastimes. He gets up at 6 o'clock, he makes his pot of coffee, the market's opened out east, and he spends like 2 to 3 hours. He reads about the companies, he sees, all their new research and development, what's happened with their management teams, who are they merging with, who did they just hire as a key salesperson? And then he buys and sells and buys and sells. Can I tell you statistically what the odds are of my buddy outperforming the market?
Pretty terrible.
About this much. Because he's still my buddy Tom with a pot of coffee in target range. He's not a supercomputer. He doesn't have the statistical capacity to run 1 billion variables through his mind. Okay, He does it really for fun. And sometimes he makes some big wins and sometimes he has some big losses. But statistically, at the end of the year, me, who literally never buys and sells, I will outperform him because of something called weighted average investing. And if you don't take anything away from this, take this away. Weighted average investing works like this. You make a decision how you're going to allocate your money. Say I put $100 away into my 401k and the university matches me $100. So every month on the, just say I get paid once a month, every month on the first of the month, I have $200 going into the stock market. And I've got it allocated exactly how I want it. 10% international bonds, 10% United States bonds, 60% global, global stocks, and 20% money market. So what happens to my $200 the first of every month? It gets sliced and diced into that pie. And when the market's really, really screaming up, I'm buying high, which is not a good thing. And when the market's really diving, and this is just happenstance, it's high on the 1st of February, that sucks. It's low on the 1st of March, yay. I buy in high, I buy in low, I buy in the middle, and I do that the first of every month for 40 years. Statistically, I will perform at the highest possible return on investment, even taking into account the supercomputers. It's just, and I can't explain it to you other than I know that it's a truism. That buying high, buying low, buying in the middle, buying during a crash, buying during a spike, all weighted average, just plodding along, you will always end up at the top of the yield heap. Are you guys sold?
Sorta.
It just mathematically works out. Gabe?
I do think mathematically that's definitely true, but if you pay a little attention, I think you do have some chances to get big windfalls. Like, say you invested heavily in cruise liners at the beginning of the pandemic when their stock crashed, you have a chance now. You would have made probably 50% interest, or they're shooting up now, and you
Sure.
do lose an opportunity if you never pay attention. But also, if those also bring opportunity for risk, because it is just gambling.
And that's exactly it. I hate Vegas, but as you can imagine, being a numbers person, I love the craps tables. Can't stand roulette, can't stand blackjack, but I love the odds on the craps tables. And I always like to tell my husband, I always win. He's like, no, you don't. You only remember when you win because you had a bunch of fun. About half the time you lose. Okay. That's exactly what this is like too. It's a kick. If you're into it and you watch it, you have the potential to make windfalls that I will never have with my little $200 on the first of each month going into its little allocated portfolio. I totally agree. But neither do I have the chance to drop off the end of a cliff and lose everything I've worked my whole life for. So yeah, it's how much. Yeah, do you like to play? Are you a player? You like to be out on the table, or you just want to be this? And then I'll get off of this tangent. But I also know a lot of people, myself included, that carve a little tiny piece out just for giggles to play with, quote unquote, to follow a few things. And yeah, but you as young people, what you want to do is say you got to start by putting away $50 a month. And then when you get to your first 1,000 or 2,000, you need to get it into a retirement account like an IRA. And then you need to figure out your percentages, 20 here, 80 there, right? And then just do it every month. It doesn't look very sexy. It's not very exciting. Nobody's going to be sitting at cocktail hour bragging about their yield. But I can guarantee you, if you stay on that path for 30 or 40 years, it pays off. Okay, so here's the scoop. First line, I've got common stock, 250 shares, McDonald's, that's a blue chip, right? It's been around for 70 years. I bought it in 2005. Can you guys calculate for me what he paid per share for that, please? What do you pay per share for his McDonald's stock in 2005?
Is the original price the amount of investments?
Yes.
35.26.
35, yeah.
Yep, he did. He paid $35.26. What's it trading for today?
40,430.
How much per share?
$161.72.
Holy crap. Okay. So right away you're like, that's amazing. It went up from whatever, $35 to $161 a share. How long has he held it for? And go back up to the date that we're running this inventory. Roughly, how long has he held it?
13 years.
To almost 13 years. Now I want everybody to go verify the cumulative return. Ending value minus beginning value plus income divided by beginning value. That same calculation we ran, but they haven't told me anything about dividends, so I'm just assuming there were none, which that's not a good assumption, but that's what we're working with. Ending value minus beginning value divided by beginning value. Verify the cumulative return. Which I haven't done. I hope they did their math right, and they did. Do I have a thumbs up on verifying the number? Okay, now, Carson, what am I going to divide by to get the annual yield? And just round it. I'm not looking for days or months.
You divide by 13, right?
I think let's just divide by 13. It's not quite 13 years, but whatever. Now we're coming to a number that we can really wrap our heads around. What's the annual average yield over the last 13 years for McDonald's? Michaela?
I'm sorry, I'm a little lost.
Okay, let's start back here. Make sure that you guys all understand what these things mean. Amount of investment is what? That's the cash I bought it for in 2005. So I divided by that 88.15 by 250 shares, just for giggles. You don't need it for this, but just, I paid about 35 bucks a share for it. Latest market value is what we're just going to learn in a second. Oh God, I cannot use my hand. It hurts so bad. Latest market values, we're going to go look that up on Yahoo. And that's like, what was it trading for as of April 9th, 2018? And I got a per share amount and I multiplied it by the 250 shares and it's at this. The next column said, what's the cumulative return? And that was that same calculation we did on Thursday. Ending value minus beginning value divided by beginning value. And so we all verified it's 3.58, but when you translate it to a percentage, right, it's 358%. My next question was, that doesn't, I mean, that's just some crazy number that has no meaning. I have to always translate things to an annual rate. So I divided by 13. 13 years, the difference between 2005 and 2018, right? So Shasta, what did you get for your annual return?
So at the very end, you times it?
Nope, it's taken me 13 years to earn 358%.
So divided by 13?
I need to divide it by the number of years I've held on to it to annualize the number, because we always bring things back to an annual number. Otherwise, how can we compare, right? 27.6%. Now you should be able to tell me something about how McDonald's has performed over the last 13 years, because you guys know what the Standard & Poor's does on average over time. What was that number? Anybody remember that? Was it like 2% or like 20? What has the stock market done on average over 91 years? I think
I thought
about
it was-
8 to 9%.
Okay.
And that's super high risk stuff, that's super low risk stuff, everything in between. We've seen those huge crashes, we've seen the huge spikes, 8 to 9%. This thing has done about 27% a year. I would call McDonald's pretty freaking good. Now go try Disney. What did I pay per share for Disney?
$33.81.
Yep. What's it trading for now?
$110.85.
Yep. Can you compare the 227% that I made at Disney with the 358% I made at McDonald's? Yes or no? Can you just compare those two raw numbers?
No, they're over different periods of time.
They're over different periods of time. So please tell me what Disney earned annually. What did Disney earn annually? And again, just round it, round the years.
I got 20.7%.
20.7%. They performed not as well as McDonald's. Okay. Now we're down, we have 3 common stocks, which is just one share of that company, Intel, Disney, McDonald's. Now we go down to something called an ETF, Exchange Traded Fund. That's exactly what I was telling you, where you buy something that just follows the market as a whole. So you pay somebody to buy a little piece of every single international bond that's out there. And one share might have 20,000 bonds in it. It's a mutual fund that does nothing but follow the international bond market. And wow, look at that, 7%. Tell me how much annually I've earned on my international bond ETF. What's my annual rate been on that? Anybody?
$1.75.
1.75. Why the hell would anybody in the whole wide world invest in international bond ETFs when we just saw McDonald's and Disney doing 20 to 27% a year? And there's a 2-word answer, or 1-word answer actually. Why would they do that? Asher, what do you think?
It's the safest investment you can make because it
But
goes up.
why am I interested in safe when I could be doing 27%?
Because you could also lose money on common stock.
You could. And what's the whole point of having all of this different portfolio of all this different stuff? It's called
Diversifying your portfolio.
diversification. The reason I'm earning 1.75% on my international bond is because it's diversification. There's a small little percentage of my portfolio that's really protected in bonds. Then I've got some healthcare mutual fund. I have no idea what a contra fund is. So this is what an inventory looks like. This is what you're going to hand in tonight, number 14. Let's go find out how we figure out what McDonald's or Disney or Intel is trading for today, because you can't do this column until somebody tells you how to look up the data. And again, No, got it. Poor hand. Okay. Finance.yahoo.com. Easy. Easy peasy. Finance.yahoo.com. I have no idea, idea what the symbol or the ticker is for Intel. So I'm just going to type in the name. Oh, I put an extra. And right away, it comes up. Are you looking for Intel Corporation? Yep. It trades on the NASDAQ, which you would expect because NASDAQ is tech. So I'm like, and here's the symbol is INTC. That's sort of weird. Okay, click. Now I'm on the page dedicated to Intel. There's so much more information here than I could even begin to interpret. I'm going to just teach you what I think like a beginner would need to know. Right now, Intel the market closes at 4 o'clock Eastern Daylight Time, and it was trading for $65.56. It had gone down 0.98%. No, I'm sorry, 98 cents, or about 1.5% from the prior day. There's this whole other thing that happens after hours. I don't really understand it. I certainly can't explain it. So let's just keep our focus over here. Okay. And the numbers are always really super close. Okay. Now, again, using my poor fingers here. So it closed yesterday at $66.54. These, your open, your bid, and your ask were part of those different orders you could place. Remember I talked about that before, stop loss and limit. You don't need to get too into depth with that either. Here's what it's traded between today. Today, before the market closed out east, it traded between $65.29 a share and $66.57 a share. Within the last 52 weeks, it's had like a $24 range. Volume's important. 23 million shares of Intel were traded today. And that number in and of itself probably doesn't tell you a lot, except for compared to the average volume. On an average day, 36 million shares trade. So that tells me, and again, this is just my very, very beginner's understanding of this, but that there's not anything new or exciting happening with Intel. Good news or bad news, volume jumps. This was like a below average trading day. So probably nothing like financial newsworthy. This is a very, very, very important number. You need to know this number. This number says 266.983B. The B is billion. The market cap, that's like slang for market capitalization. Big ass long word, capitalization. Market cap says take what this closed at, $65.56, and multiply it by the number of shares of Intel that are out there with people, and that's how you get market cap. So $65.56 times some number, say 7 billion shares, gets you to the market capitalization. What happens to market cap on a daily basis based on that formula I just gave you? Does it stay the same? No. Philip's shaking his head no. How come?
Because people are buying and selling every day, right?
Yes, people are buying and selling, so market cap fluctuates. You think this looks like a huge number. Oh my God, 266 billion. For giggles, let's go see what Apple is. Okay, and I didn't know the ticker. Here's the ticker. Apple 2.1 trillion. There's a T after it. Okay.
So
Volume. Go ahead.
what does that tell you?
It doesn't really tell you a whole bunch other than everybody pays attention to it. It's like if everything stopped today and all the shares of Apple were just converted to cash, there'd be $2.119 trillion. Like that's what all of the shares are worth today.
But that's not what Apple's worth.
No, it has great question.
It's just what their stock is worth.
It's what their stock's worth today. Tomorrow morning at 8:05 Eastern time, it's going to be worth some number that isn't that.
So then is that money going to the, well, I guess it's going to this.
It's not
Getting
really
dispersed.
money. If you
Dispersed.
had 100, why don't you guys all do this? How much would you have in your portfolio right now if you had 60 shares of Apple? Go. What would your if you had 60 shares of Apple, what would your investment be worth right today? As you went, as you went to bed tonight, what would you be worth?
$7,572.
Yep. Apple stocks closed at 126.21 times, how many shares did I say?
60.
Times 60 shares. You would go to bed and you would be worth $7,572.60, right? You don't use pennies, you round up.
So Lisa,
Yep.
get that number. You're using the previous close, not open, right?
No, I use today's close.
Okay.
126.21.
Okay.
Okay. My son used to work for Tesla, and it's about the only stock I follow because he gave me a couple shares. Okay, so it went up 57 cents or 0.08% today. The market cap, 663 billion. Beta is a number that identifies, oh, God, this is so pathetic. I feel like I need to look this up to explain this correctly to you. It identifies the relationship between risk and reward. The higher the beta, the riskier the stock. A 1.0, if your beta, let's see, beta in stock market. If your beta is a 1.0, it is exactly neutral for that kind of industry. So electric vehicles, tech, obviously you have to take more risk to make more money because they're just higher risk in general. Okay, basically that's what the definition says, so I feel okay about that. Okay, so far the important things you need to know: what did it close at? This is the actual dollar change. This is the percentage change in one day. This is what it closed at yesterday. You should be able to look into, I could say, hey, that's pretty big, $15, right? It went up and down a lot today. 52-week range, it's been as low as $100 and as high as 900. Wow, that's volatile, right? Today's volume was less than the average. And people that know the market would be like, oh, duh, that's because it's the second Tuesday of April. That's always a low trading day. I mean, people that are in this know all this stuff. I don't know why it was a low trading day. Market cap, the value of all the shares today, 663 billion. Beta, it's higher risk than an average stock in its category, which makes sense. Okay, PE ratio. There's a couple more things you need to know. PE ratio, that stands for price to earnings. The price, you know, $691.62. The earnings, and so this is a ratio, P divided by E, price divided by earnings per share. PE ratio, price is the numerator, earnings per share is the denominator. The earnings per share is right here, the 0.64. The relevance of this, you guys, so let's just check their number. Calculate the PE ratio and see if you can get to 1,080. Price divided by EPS. And this might be calculated like on yesterday's numbers or a rolling average. I don't know. Let's just go check it out. Oh, no, that's current. Okay. PE ratio of 1,080. Everybody verify the number. 691.62 divided by 0.64. Crazy thing about that, this number indicates whether or not the price of the stock makes sense compared to what it's earned. We're told in general, anything over 20 is pretty high. This is 1,080. And then you can go down here and look at this, overvalued or undervalued. Wow, it's really, really, really overvalued. What does that tell you if you're thinking about buying Tesla today?
Possible there could be a massive drop in stock price.
Oh my God, 1,080. Let's go look at one of the blue chip stocks. Let's look at GM. Look at their PE ratio. Price divided by earnings. PE ratio is indicative. It's trading at X times its earnings. GM is GM is trading at 14 times its earnings. And we know, just super rule of thummy, that anything over a 20 PE ratio is trading pretty darn high. Okay, you guys name a company you want to look at. Anybody? What's interesting to you?
Six Flags.
Now that may very well be owned by a parent company that I don't know. Oh no, here, Six Flags Entertainment. Thank you, great. Okay. Now there's some interesting stuff going on here. Six Flags, you know how to do all this, the range, blah, 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 the volume, market cap, a paltry 4 billion. Beta, it's a little higher risk. PE ratio is NA because the earnings per share is a negative $4.99. What the heck does that mean? How could you have a negative earnings per share?
They didn't make any profit this
They had a
quarter.
loss. They had a net loss last year, which kind of makes sense considering we were in a pandemic. How many people were standing in roller coaster lines cheek to jowl in 2020, right? So you can't have a PE ratio if you've had a loss.
Could we look at Berkshire Hathaway?
Sure. Okay, and there's different classes. I'm not going to go into this. I'm just going to pick the first one. It's how, I'm not going to go into it. We're just picking one. Okay. $263 a share. 52-week range. There's been kind of a lot of volatility. It looks like it's about valued correctly. 604 billion. Low, it's lower than a 1.0 beta, so not super risky. PE ratio, Jesus criminy. $26,667 of earnings per share of stock. And it's only priced at $262 each. You can't really do the math on that. Okay, last thing, and I'm not going to go through all this because there's so much here, but like, I want, you know, anything, the company outlook. This is where all the financial analysts talk about like what's happening next with Berkshire Hathaway. Charts till your eyes glaze over. Conversations, blogs where people are talking about this. Stats. Again, you know, like I'm a numbers person and most of this just makes me go wonky. You know, on and on and on. Sustainability, that is very interesting to me because that's an area of interest. And then up here you can see, what did the market do today on the whole? The S&P 500, which are the biggest 500 stocks, the Dow 30, which is the blue chip stocks, Philip, those are the big 30, the NASDAQ, right, which is tech, and the Russell 2000. I can't honestly give a good description of that other than I know it's 2000 stocks. Okay, so I want you to do one thing before we end. I want you, so that was finance.yahoo.com. This is your homework for tonight. You need to make this spreadsheet. If you want to do this here, that's called merge and center, where you go between multiple cells. Let's see, and let's see in your homework is number 14 on page 468. And the first thing that we have to know is what date. Oh, today, duh. Okay, so I want to know as of 4/6/21 today. You know when they're purchased. You know how many shares there are. You know what my original investment was. You look up the latest market value, and you just learned how to do that, right? Stop me if I'm going right and you're like, I don't know what you're talking about. You know how to look up latest market value. Whatever the market value is, you got to multiply by the number of shares, obviously. How are you going to get the cumulative return? If just for giggles, the number here was 20,000. So say they were worth 20 bucks a share right now. If the latest market value is 20,000, calculate the cumulative return for me. One more practice. If the latest market value is 20 bucks a share, you just looked it up. What is my cumulative return? Go ahead.
117%.
2960 divided by 17,040.
Wait, 2960?
Wait, just
Sorry.
20,000
20,000.
minus 17,040. So it's gone up 2,960 bucks, right? Divided by what I paid for it. I've earned cumulatively 17.37%. I'm sitting here right now in 2021. So what am I going to divide that by to get an annual return?
10.
Yeah, divided by 10 years, I can eyeball that. Not very impressive, 1.74%. Okay. Test on Thursday. You will have to do the life insurance worksheet. You will have to do a health insurance worksheet. I've told you that for like the last 3 weeks. We've practiced them. The solution manuals are open. If I'm studying for this and I got anything less than a perfect score on either of those, I'm going to go back and rework them. What else? So life insurance was chapter 8. I'm just trying to think. Property insurance. Just again, reviewing the difference between, you know, the deductible, collision, comprehensive, health insurance. We did a worksheet. This is what we're focusing on for chapter 11. And then you're using the multiple choice and the true and false are based on the PowerPoints and, you know, the videos. Now, let me just take you in the last couple minutes and show you, again, it's one of these wonky things where you've got more than just one piece of paper, which is just how that all goes. So of course you're going under, you know, section 12, right? Reviews, tests, final. And again, this isn't open because it's only Tuesday. I'll open it late Wednesday night. But you'll open the test itself, right? And it's going to have, let me just show you this really quick. It's going to have a bunch of true, false. Oops. And then it says, that's all that's on this. Then it says, the short answer problems are all on the answer sheet. That's what you'll submit. So all you use this for is the true and false. The answer sheet, which is going to be open right below it, has got where you enter the true and false, obviously. Right here, I answer all my true and false. And then the short answers, you just answer right on here. And I tell you, show the work and then put the answer above. Blah, 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 blah. Okay. So this is what you submit. You get the true and false from that other one. You're going to submit the answer sheet. And the only other